net interest to revenues, we're looking at almost 40% of individual income taxes by 2034, which is a significant number when you think about it. How is the government going to be able to pay for this is my question.
Yeah, I know that. And it's something we think about a lot is the issue of sustainability that you
Yeah.
raised.
The Congressional Budget Office is projecting that debt held by the government will reach $50 trillion by 2034, which equates to roughly 122% of GDP over the next 10 years, which will be a 25 percentage point increase over 2023's number. Additionally, the CBO is projecting the deficit level to rise to 6.9% of GDP by 2034. What is driving this growing deficit and debt level in the nation? Well, we'll talk about this with our next guest, Phillip Swagel, who is the current director of the Congressional Budget Office, and he served as the 10th director of the CBO since 2019. Prior to the CBO, Director Swagel has served in the public arena in a number of capacities, having been the Assistant Secretary for Economic Policy at the U.S. Department of the Treasury from 2006 to 2009 under the George W. Bush administration. During this period, he worked on policies to address the global financial crisis, including the Troubled Asset Relief Program, and he sat on the TARP Investment Committee, which decided which of the banks would receive bailout funds. He also served as chief of staff and senior economist at the Council of Economic Advisors in the White House, and he served as an economist at the Federal Reserve Board and the International Monetary Fund. Director Swagel, it's an honor to host you today. Welcome to the show.
Yeah, David, thanks very much. It's a pleasure to be here.
According to your 10-year outlook, the current deficit sits roughly around $1.9 trillion for fiscal year 2024. That's expected to grow to roughly $2.8 trillion by 2034, which equals almost 7% of GDP, which is notably higher than the 50-year average of 3.7%. Importantly, I believe in an earlier report that the CBO published earlier this year, it's noted that this trend could reach a level that hasn't been seen since World War II. Am I correct?
That's right. And this is a sign that the U.S. fiscal trajectory is on a very challenging path. That, as you said, we have very wide deficits. We put out the monthly budget report was for September, but September is the end of the fiscal year in the U.S. So October 1st is a new fiscal year. So it gave the deficit for all of last year, and we projected that at nearly 1.9 trillion. Is just a little bit over 1.8 trillion. So it was 1.83 trillion. You can go out some more decimal points, and that follows 1.7 trillion in the previous year, in fiscal year 2023. And as you said, this is more than 6% of GDP. It's getting up close to 7% of GDP. And these are challenging figures on their own. What's especially unusual is that we have such a large deficit when the U.S. economy has recovered from the pandemic, and we're growing. We're continuing to add jobs. The unemployment rate has risen, but is still pretty low by historical perspective. So things in the economy are doing reasonably well, and yet we have this massive deficit, and that's what's unusual.
And importantly, in the report, it specified that since the Great Depression, deficits have only exceeded this level shortly after World War II and during the 2007 and 2009 financial crisis.
And the pandemic.
And the pandemic itself.
With that, exactly. But as you said, it's really in response to these emergencies, these macro events, whether a conflict or the financial crisis or pandemic. And yeah, that's what's so unusual, is that we're past the pandemic, and yet we still have this deficit.
Director Swagel, what are the key economic assumptions behind the 10-year forecast? So outlays are expected to continue, but per a widening deficit, that means that the growth of outlays has to outpace the growth of revenues. Why is that?
No, that's right, and that's the way we do it for our 10-year projections that we publish in February. We publish an update in June. We're working now on our next update that will come out in January or February of 2025. We start with the demographic projections, so we look at fertility, mortality, immigration in both directions. And so that's demographics. Then we look at the economics. We do an economic forecast. Then we look at both spending and revenues. We do a projection of revenues. We do line by line on the spending side. So anything the federal government spends on, I have a colleague here at CBO who's an expert on it, and they do a projection. And then lastly, we do net interest outlays. So depending, as you said, depending on the spending and the revenue and the interest rates in the economy, that then says, well, how much are we spending on interest, on net interest outlays, and we put that together and make the projection. So it's it's a couple month process here, and we're kind of just at the beginning of that.
And it's assuming steady growth in the economy, right? No significant spurts of high growth or a recession.
Yeah, so we're updating our forecast now at the beginning of the budget update, but we see a pretty good economy. We've had strong growth, stronger growth than we expected even at the beginning of the year, even as inflation has continued to come down. Job creation has continued. The unemployment rate is still low. It's gone up a bit from where the lows of a few months ago, but overall, it's still a pretty good economy. So we don't. I don't know what our next forecast will have. I suspect it's not going to have a recession. It's not going to have a crisis just because, there's always risks, but it doesn't seem like we're on the verge of a big problem like that.
If you were to take a look at my screen here, I have here the table, and I'll just put it up for the audience to see. This is the budget outlook by fiscal year.
Yeah.
Here we have outlays broken down by of different things. Which of these items, Social Security, medical care, major health programs, and defense and non-defense spending, which of these items do you expect to grow the most over the next 10 years?
No, great. This is great. And thank you so much for putting this up. And this is on the CBO website, cbo.gov. I'll say, we also have a one-pager that presents this, in a one-page format. So here's the challenge for the U.S. is that in the near term, it's the net interest outlays. So that's toward the bottom of the screen, where the historical average. Good, you're highlighting it. Yeah, that's perfect. Thank you so much. The historical average was about 2.1% of GDP. And you can see, your viewers, the audience can see that we're well above that now. Net interest outlays in the fiscal year that just ended came in north of $900 billion. So we project, or even a bit higher than what we had expected, and are on track to go, yet higher. And so those are resources that are not available to our government for other purposes, right? If a policymaker wants more spending, or on whatever, on this on the screen, you can see on defense, on non-defense, on social purposes, or they want tax relief. Those net interest payments are resources that are not available for that. So that's kind of the near term. Over the longer term, it's more in the middle of the screen where you have on the outlays is the mandatory outlays. So there's Social Security, and then, as you said, the major healthcare programs. Viewers can see that Social Security right now is the largest single program of the federal government on the outlay side, on the spending side. And that's continuing. Those outlays are continuing to rise because the U.S. is an aging society. On the other hand, healthcare spending rises both because the aging. Thanks again. You're highlighting it, which is perfect. The Medicare program in the U.S. is, in some sense, the biggest driver of our long-term deficits, along with Social Security. And that's driven both by aging, and the older population requires more healthcare spending, but then also with excess cost growth in healthcare, that health costs rise by more than GDP, right? So health costs rise faster than the overall economy. And so that also drives our fiscal imbalance. So it's a long way saying it's the near term, it's interest payments. Over time, it's mandatory spending, Social Security, Medicare, other health costs, and then, of course, for the deficit, it's revenues also, and it's some mix of those.
Yeah.
Either there's more spending than revenue, or insufficient revenue compared to spending, but that just highlights the choice that policymakers will need to make in the future.
I do have two questions on the net interest item, which
Mhm.
is fascinating for some of the economists that I've interviewed. So the first question is whether or not this trend is, per their words, sustainable. Now, I noticed that by 2034, the projection is 4.1 trillion.
Mhm.
Sorry, percentage of GDP,
That's
4.1
percent.
percentage of
Yep.
GDP. My apologies. And the revenues are going to be 18% of GDP. So we're talking about, just from a perspective of net interest to revenues, we're looking at almost 40% of individual income taxes by 2034, which is a significant number when you think about it. How is the government going to be able to pay for this? Is my question.
Yeah, I know that, and it's something we think about a lot. Is the issue of sustainability that you
Yeah.
raised? For now, the U.S. Treasury is able to finance this, this fiscal, situation. Is sort of all the numbers on the screen, right? We're able to borrow as a nation at interest rates that are still reasonably low, and the 10-year Treasury bond, as we speak, on was just above 4%. So that's higher than it was, say a couple months ago, but it's lower than the 10-year Treasury yield has been, in certainly, the history while you and I have been alive. So the Treasury can fund, in that sense, is the good news in the short term is that there's not a crisis. But the problem, as you point out, is that over time, these interest payments will rise. And that's the problem, is that at some point we know we're not sustainable, that at some point there has to be adjustments. The challenge is that in between, so I know we're sustainable now, where we can continue to borrow.
Mhm.
At some point it will be a problem. The challenge is figuring out when, this is when things become dire in between.
Okay, and the second question is whether or not a rising deficit would cause inflation. Can you answer that?
Yeah, I mean, the answer is going to be one of these economists. It depends,
Hmm.
because a rising deficit, will certainly lead to rising interest rates. And that will have an effect on business investment, on consumer spending, on job creation in the economy. So there is some crowding out. It's pretty modest for an incremental amount of debt,
Hmm.
but we've added a lot of debt, and that's the problem. That even if crowding out is it's kind of small for small a little at a time, boy, we have a lot of it, a lot of debt that's been added, and that means that crowding out becomes more important over time. Again, this is all over time. Um, so that's the problem. So we know that deficits will have that effect. They mean for inflation depends on the interaction with monetary policy.
Hmm.
Inflation has come down, as the Fed has raised interest rates and kept them high until its recent cut. And then also on the supply side of the economy, we've had the supply challenges arising from the pandemic have backed away. So the port situation is basically back to normal, as I understand it, or much closer to normal than it was during the pandemic. Our labor force challenge has also subsided to some extent as the economy has cooled. We've had a surge of immigration that's increased the labor force as well. So some of the supply challenges have diminished. The Fed has tightened, and that's brought down inflation. These deficits, what they'll mean for inflation in the future, depends again on all of this, on the Fed, on supply conditions, all of that together.
Do you think, and I know that the Fed is an apolitical entity, but do you think the Federal Reserve will look at this projection, Director Swagel, and think that they will need to keep rates low in order to not overwhelm the Treasury with very high rates?
It's an interesting question. And look, there is that interaction, as you say, that high interest rates have a effect on the fiscal side, on the cost of borrowing, and that feeds back into deficits. On the other hand, monetary policy has, goals and statute, and that's, the labor market and the economy,
Mhm.
and inflation, financial stability. And so that's where I expect monetary policy to be focused, is on meeting the Fed's goals, maintaining low inflation and financial stability, and labor market that continues to add jobs and have a low unemployment rate. What it means for the fiscal situation in some ways is a challenge for fiscal policymakers. I don't expect, I expect fiscal policymakers to have to address that fiscal challenge.
Okay, so Director Swiggle, I'm looking at the revenue side, and why is it that the CBO is projecting a lower rate of growth for taxes than outlays?
Okay, no, very good. No, thank you, David. It's an interesting situation. And this is what we're doing is we're projecting both the outlays, the spending, and the revenues based on current law. And so the outlays are being driven on the mandatory side by the programs, Social Security, healthcare spending. Those in turn are driven by demographics in the economy. So as we age, for example, we have fast growth of healthcare spending, again, because of the aging of the society and high healthcare cost growth. On the revenue side, it's driven by economic factors. And so the growth of the economy, growth of inflation, right? Since we tax nominal income bases, in higher inflation in the past gave rise to higher revenues, and slowing inflation will mean a deceleration of revenue growth. And then income distribution matters since the U.S. has a progressive tax system. So if there's more inequality, that means more revenue. More income at the top means more revenue. The other thing I want to mention, so it's both those factors. The other thing I'll mention is the nature of our projection is based on current law. And so in current law, large parts of the 2017 Tax Act expire at the end of next year. So at the end of 2025, we revert to the pre-December 2017 tax rates. That's on the personal side of the U.S. tax code. And that means it's nearly 1 percentage point of GDP in additional revenue in our projections in 2026 and 2027 because of that. So we actually show higher revenue coming in because of the expiration of the tax cut. Now, there's lots of discussions during the current presidential campaign about whether to extend some or all of those provisions, but none of the costs of those extensions, whether all of it, as one candidate has proposed, or the less than $400,000 income families, which is more than half of the tax cut that's expiring. None of those costs are in our budget projections yet.
And for fiscal year 2025, well, first of all, before we comment on the election itself, can you just give us a projection of the deficit level outlays and revenues for fiscal year 2025 based on the latest summary that came out?
Oh, sure. So we, again, I'll start by saying we're updating this now, so we'll have a new projection in January or February. We expect a continued high deficit in 2025 based on the current law. As of our June update, we had a deficit in fiscal year 2025 just above $1.9 trillion. And then, revenues equal, more than 5 trillion, outlays, nearly 7 trillion. So this is a deficit that's, again, between 6 and 7% of GDP. So it's just really high by historical standards. And that's, contributing, as you said before, to rising debt levels as well.
How does this compare to 2023?
So 2023, the deficit came in at $1.7 trillion. Is that number? So that's the actual deficit. It's a little bit, I just say it's challenging. I'm pausing here to find the right word. There are court decisions that basically canceled the debt cancellation, which kind of sounds funny, but President Biden had put forward a program to cancel a bunch of student debt, and that was booked. That was, the White House booked it in the budget figures. The courts the next year said, no, you can't do that. And so it was never implemented, and it had to be unbooked. And so the deficit in 2023 on the books, it says 1.7 trillion. If you take out the cancellation that never happened, it was 2 trillion. So that's kind of the way I think of it, is that 2023, the deficit was $2 trillion, not counting the student loan, kind of off and on. So you could say, oh, the deficit's come down, right? We came from, say, 2 trillion in 2023. Now we're talking about like 1.8, 1.9. There's still very high figures, given what the state of the economy, still north of 6% of GDP, which is just an unusual deficit at a time when the economy is doing pretty well.
Okay, my only question on the election is whether or not the projections and assumptions behind these projections would change depending on a Harris or a
Mhm.
Trump victory.
Yeah, no, it's a good question. And the way we construct our budget projections is based on current law. So, a new president will be inaugurated next year, on January 20th of 2025. He or she will propose, will make proposals, and then the Congress will act. Once the Congress acts, we will then incorporate, the new laws into our next budget projections. So it's not in there now. That's the immediate answer to your question, is the programs of the two candidates is not in our projections now, but it will be once they're elected and once enacted. We will make those updates. And that's really our job. Our job is to inform the Congress. We work for the legislative branch. And that's what we'll do. Whatever happens, we'll update, and just to make sure that the members of Congress have the best information that we can give them.
And I know that there is various think tanks and research groups that have made estimates and projections as to how the deficit would change. The Penn Wharton study, for example, that was reported a few weeks ago, explained how a Trump presidency would have a higher deficit than the Harris presidency. What assumptions would that be making for higher spending under Trump, for example, per the Wharton study, not per the CBO?
Right, right. No, I understand. Yeah, and those other groups, Penn Wharton is one, and there's other groups like that. They really do excellent work, and I think of them as a useful complement to what we do. Um, uh, so I can't say what they've done is right or wrong, just because inevitably they're making assumptions about what the programs are of the two candidates. And since the thing that's just different about CBO is that we would wait until the law is enacted, and then we'd update our budget projections. So when Congress makes proposals, when there's legislation being considered on the floor of either chamber, the House or the Senate here, we would provide a cost estimate to the members of Congress. Well, how much do we think it will cost? And then once it's enacted, we'll update our budget. So, we don't have that kind of, the kind of analysis of the two candidates' programs. We would wait till one of them is elected, and then we'll do the analysis.
Now, if you take a look at my screen one more time, Director Swagel, this is from the St. Louis Fed, and it's just a historical chart of the federal deficit or surplus as a percentage of GDP. As you can see, during the Clinton years, we had a surplus, and it's been in a deficit ever since. The rising deficit, though, has not put us in some sort of economic depression and or even a serious recession, except for COVID and the great financial crisis. Is there any relationship whatsoever between a rising deficit and or rising surplus and economic growth?
Yeah, no, it's a great question. This is exactly the right picture to show to your viewers. We would say yes, there is, that it's a relationship that matters, but it matters over time, and so the relationship goes from deficits to debt, and then that affects interest rates, because it affects the resources available to businesses and to consumers, right? So this is the classic crowding out analysis. And the thing that's important for the U.S., or one thing that's important for the U.S., is the availability of capital inflows. That capital wants to come here, and the U.S. government and businesses are able to borrow at interest rates that are still pretty attractive by historical experience. So the rising debts driven by continued deficits do matter, but they matter a modest amount at any one time. because of the availability of international capital that helps keep interest rates low and resources available to businesses and consumers. And the challenge would be if global investors at some point in the future hesitate to provide more resources to the U.S., start to worry about the capital that they're providing to the U.S. And I think we're at a very distant from that. So that's why our projections now don't have a crisis. We don't see a crisis next year. The U.S. government can continue to borrow, continue to fund itself. At some point in the future, that's the challenge.
All right. Well, we'll follow up at some point in the future then. But one final
Yeah.
chart I'd like to touch on with you, Director Swagel. This is from the FDIC website. I'd just like to draw your attention to this particular chart. Unrealized gains and losses on investment securities from banks, held maturity securities, and available for sale maturities securities. Both are underwater in terms of unrealized gains, in this case losses. These losses, unrealized losses, exceed that of 2008 by a tremendous margin. Now, you looked at, you're one, you actually were one of the architects of the Troubled Asset Relief Program in the Great Financial Crisis. Looking at this, Professor Swagel, are you concerned about the health of the financial sector?
No, thank you. This is a really interesting chart. And, sometimes the events of 2008, 2007, the housing bubble and the TARP and all that, sometimes it feels like a million years ago. Sometimes it feels like yesterday. So, this is looking at this, it feels like yesterday. Look, this is worrisome. It means that, there are losses that financial institutions have on the assets that are on their balance sheets. On the other hand, the financial sector and the banking sector in particular has a lot more capital now and therefore can absorb losses in just a much greater scale than was the case back in 2007, 2008 during the financial crisis. And the bank regulators, the Fed, OCC, FDIC in the US have much greater visibility into the challenges. It's not perfect. We saw bank failures last year, Silicon Valley Bank and Signature, First Republic. It's not perfect. And there certainly can be, banks that run into problems with changes in interest rates and other things. And so, I'm not denying at all that this is a worrisome chart. On the whole, the financial sector is in better shape than it was in the past. And so that still gives me some comfort.
So final question, just to follow up. So in what hypothetical scenario would we need a second TARP? And, what is the likelihood of that scenario happening in the next couple of years?
Yeah. It's really hard to know when a financial crisis will happen. And in part because it can happen both in instances in both directions. We have the economy affecting the financial sector. A really bad economy can affect the financial sector. And of course, there were worries about that at the beginning of the pandemic. It didn't seem to, to be the case. It didn't play out. Or it could be like in 07, 08, where problems in the financial sector and especially subprime lending and other, in housing affected the overall economy. So it could be in both directions. There's, like I said, much more capital. There's more authorities in the wake of the financial crisis. The 2010 Dodd-Frank Act was enacted that provided policymakers with new tools. We haven't tested all of them yet. The resolution authority for a large financial institution, that authority hasn't been used yet, but it's there. So policymakers have new ways to respond to a financial crisis. There's a sense in which we won't know until the next one comes. But, at least for now, it looks like our financial sector is in much better shape than it was back in 07, 08.
Very good. Thank you very much. Where can we learn more about your work and the CBO's work?
No, David, no, thanks so much. So the CBO website is cbo.gov. There's lots on that, anything your viewers are interested in. And I'll say, the thing I would recommend to start is the one pager of our budget and economic data. And that's the first thing I would look at and then go from there.
Okay. Thank you very much. And we'll put the link in the description below. Thank you for watching. Don't forget to like and subscribe.
David, thank you so much.